What's up everybody, Logan here again with another video coming at you. What a crazy market it's been, and I'm super excited to get into this one. But first, I want to talk about this video's sponsor, Lolly. So Lolly is a really cool app that I've had. You guys can check the link in the description to download it. Please follow that one if you're gonna do it. But Lolly is basically a rewards company that gives you a free Bitcoin when you shop at 1,000 stores. We've created the easiest way for you to earn up to 30% back in Bitcoin on your everyday purchases. They work with Nike, they work with Postmates, Best Buy, just to name a couple, even Sephora, which is really cool. So it's a really cool app. I've been using it for a little bit now as well. And it says how to earn today. So if you download the Lolly app, and they also have the Google Chrome extension. If you're like, Logan, I don't have a phone, I only have a computer, I live in the Stone Age, check out the link below for the Google Chrome extension. This takes 2 clicks and less than 30 seconds to sign up for. So how to earn today: download the Lolly app, shop at your favorite stores to earn Bitcoin, check in every day for a daily stacks giveaway that they do, share Lolly with your friends and family to earn even more Bitcoin. You can transfer those earnings to a Bitcoin wallet, or you can do it to your bank account as well. And then I can go and say I wanted to search something, I wanted to buy, some shoes. I could check out Verishop, Shop Now, and now I can go around Verishop and start looking at things to potentially purchase. I do really appreciate all the support as always, and like I said, check out the Lolly link down below. You guys can see that in the description. It helped me out a bunch, and I really do appreciate it. Completely free, takes like 30 seconds, so it helped the channel out, and hopefully you guys find some value in this video of rolling spreads. So I'm on demand right now, so there's 2 reasons I'm on demand. The first one is because the market's closed. And the second reason is because I don't have any current positions on that I would need to do this to right now, as far as like what I'm going to show you guys in this video. Now I'm going to do this quick. I'm going to make this like the introduction to rolling on Thinkorswim, basically. So this was probably the highest the market ever got. So I have us currently, if you look at the date here, January 4th, this is currently at 9:35 in the morning, 48.14. I think we got up to 48.20, and that's the highest the market's ever been. Because we know what happens from here, right? We come down all the way down to, 4,200, 4,300, depending on where I put us. So basically, we're in the virtual account. We're getting $100,000. And we're just doing this just so I can show you guys a couple tactics that I like to do when rolling credit spreads that are deep in the money, right? So that's our main focus today. I don't plan on shooting for over 10 minutes or 15 on this, but we'll see where it takes us. And bear with me too, on demand's a little slow sometimes, but basically let's just take a look. Like, all right, let's say you want to do your 10 days to expiration strategy here. Or, maybe you're feeling really good about the market. Like, wow, it's up, we're hitting all-time highs. Let's just keep hitting all-time highs while we can. So we're going to go down in the options chain here. And, 10 days out, you can go all the way down to like even 4,400, and get a nice, or 4,500, right? And get decent spreads down here too, if you wanted. A lot of the value will always be found in this 80 percentile where you're like, wow, and the VIX was very low at this time too, right? So we're going to deal with VIX expansion as well. But let's say you felt really good and you're like, all right, 10 days out, I bet we're above 47.90, right? So then you go and sell that. So we sell vertical, click that. I'll sell 10 of them just for the example. Let's say you get $1.80. Let's bump this down so that we can make sure we get a fill. It's on demand, so it should fill. So you're going to see how that's going to take currently $3,200 worth of buying power, give you $1,750 in credit. So $3,250 against $1,750. Boom. Then you're going to see your options buying power reduce, right? Because now you have collateral, but you did get a credit too. You received a credit on that once this fills. Come on demand. Let's see if we get the fill. It should say working. Maybe there's, there we go. So we sold 10 of them, right? Little virtual sale right there. So buying power in effect though is 5,000 in total, even though you did receive the money, and you can see that in your buying power up here. And then your cash and sweep will tell you what your account value is as far as like now that you have received that credit, right? So that had just filled. You're going to see this kind of bounce around quite a bit down here. So don't get too married to this. But this is 10 days out. Now let's fast forward to what happens when this gets deep in the money. So we can do that by, let's see what this, I'm trying to figure out on demand. Here we go. I don't use it too much. I used to paper trade with it back in the day a lot, like for swing trading, but let's go to the 11th now. And we know the market's down on the 11th. And then you're going to see this big, once we settle in, this big unrealized loss, right? Because credit spreads, that's the nice thing about credit spreads, is like, even when your money is gone or down, it's all unrealized until you close the position, right? And all rolling is closing and opening a new position in the same order. But by doing that, you're able to preserve your capital, which is really nice. So by doing that and preserving your capital, you're actually able to continue to trade. And then also you have to know, like, hey, if I rolled this, here's my new expiration, here's what I'm doing. And then we'll get into delta matching in the next video, which is when you're not widening strikes, how you can roll. But this is why I never trade emotionally. If you guys talk to me, no matter what's going on, if I'm 300, 500 points in the money on SPX, now it's different. If you're trading Google, right? If you're trading Amazon, if you're trading Apple, for example, and you're selling credit spreads on these, here's that big unrealized loss I was talking about, where you're like, damn, I'm down $1,600, $3,700. And it's going to bounce too, because we're in on demand, right? So this now has us January 11th. This was after Powell had come out last week, the week prior to, in this time. He didn't actually just come out last week, but in this time frame. So now let's take a look at SPX. Wow, you're in the money now. What is this, 130 points? That's a max loss. You can see here, basically these spreads are only that were $5, $5 in width are basically max loss. So here, what most traders do, I receive my 1900. This sucks. My net liquidity is 9,745. Let me close the position and move on. Now, here's another thing you can do, though, is you can click on SPX, create rolling order on these 10, and you can take a look at, like, okay, what should I do here? It's probably not smart rolling this guy out just to the Monday, right? Because there's the Tuesday, because there's Martin Luther King Day. And then these, don't pay attention to the pricing right here as I kind of click through, because they're going to be inaccurate for now as I'm clicking through and changing the strikes until I tell you guys to pay attention to it. But let's say you wanted to go out, like, okay, well, maybe the market then will bounce back by January 26th. And you're looking at it, you're like, oh, I'll pay a 75-cent debit. I really don't want to pay $750 to do this. But, the strikes will stay up there. Maybe the market rebounds 130 points. But, like, I want a better probability. So what we can do is we can take these strikes and start manipulating them, right? So then we could widen it. Okay, so now I'm getting $330, 305, it's bouncing around, right? Maybe even 415, keeping those strikes. But you're like, I really don't like that. Like, I want to get creative here. I'll pull this down, let's pull this down. So, okay, I've defined my risk. I started this trade risking 37.50, right? Because you received, or 32.50, sorry, because you received 17.50 in credit, but now you're not feeling so good about it. So let's pull my sell strike down to 47.10. And if I did 47.05, just to give myself better probabilities, I'm still going to pay a $2.30 debit. I really don't want to pay $2,300 to roll this to the 26th, because what if we don't recover 50 points in the next 12 days? That's not good. Like, I don't want to do that, right? That would not be in my best interest. To pay to keep a losing position on that's not in my favor. So let's make this in our favor, which is adding 500 in collateral. Okay, by doing that, now we're doubling our max risk, but we're going to receive a credit to do that. Now I'm feeling better because I'm actually getting paid, and yes, I'm risking more money, but I'm getting paid to roll this position. Right. And I'm going to get paid 50 cents, and I still get to keep my initial credit. So you can see my cash and sweep hasn't changed. And let me work this order. Let's see if we can get filled at, like, let's just do 50 for the example, but this is going to bounce around. So now let's push it out to the 26th. You guys get to see there. All right. It filled at 65. So my net liquidity still kind of sucks. We're at 97, but now my cash and sweep is up to $102,550. So just on this position, you made $2,550 in your cash and sweep. That's not in your pocket, though. You can't cash out and say, like, I want all that money, because your net liquidity is what you can cash out of right now. But you got to remember, this is an unrealized loss. The market can bounce back for you. Well, let's take a fast forward to, let's do January 24th. We'll get that data going.
couple days before this expires. And let's see if we're still at max loss, which I'm pretty sure we were at this point. I think we're down to like 4,300 that week. Now fast forwarding in time. So we'll wait for that to load in. So as you guys can see down here, we got 10 contracts. You've already, your option buying power is 92.50. So you basically got to that $2,550 goes to your buying power. You can utilize that to trade with, right? If you were like, oh, now I can put a new trade on, boom, let's do that. But at the same time, if you're not, your net liquidity is still low. You can't just cash out and walk away without losing some sort of money here, which would be that you would lose it at cashing out at this point. It's going to update though, because it's buffering. Virtual account takes a little bit to load in new data, but that's the really nice thing is you can widen your strikes. So by widening it 5, that allows me to pull the strikes down, get a better probability of getting out. And then you can even pull that down and pay a debit if you're like, let's go at the money. And that's for that specific date, right? So that's the nice thing about rolling options right out of the gate is like, yeah, you were even deep in the money. You're at a max loss, but guess what? Since you're able to widen that, you don't have to take the max loss on that. That's why I say it's so important to never put, personally, I don't put over 50% of my account into a single play, because by doing that, you only have, if you do over 50%, you can't widen every single contract if you had a max loss event, if you were going to roll it. Now, granted, if you have like super tight stops on everything, I still don't think that's a good idea. Even if you're like, oh, Logan, I got 100 G's. I want to load this into a spread to make 10 G's this week. It's 10%. And I got super strict stops on it. Yeah, but like the market can still gap down on you overnight, gap up on you if it's a call credit spread, and you're at a max loss event. And that is very tough because there's really nothing you can do unless you're adding capital to the trade or matching your delta. And then I'll get into that, like I said, in the future video. But I just want to show you guys this thing real quick. So now we've updated. Now we're down at 43.37. And you're like, dude, like Logan, I'm absolutely screwed, man. I tried to roll. I thought the market would go back up. I'm at 47.10. Expires in 2 days. There's no way the market's going up 400 points in the next 2 days. And then that's where I go, don't calm down. Don't panic. You got 92,000 in buying power. This is your only trade you got on. You've made 2,550 on it in credit. What if we just rolled it again? You're like, well, where should we roll to? All right, well, let's take a look. So we'll run into create rolling order. I would say, all right, let's give it some more time, right? Let's look at expected moves. You're like, Logan, I don't want to pay 200. Let's see if that, yeah, this might be a little weird at first. All right, yeah, like let's say you're, this is going to jump around right here, but let's say this is the actual right debit. Yeah, let's say it's 105. I was going to say with the pricing and how deep in the money you are, this is going to jump a lot, right? This debit that you'll actually fill at, but I would say it should be about 105, maybe $2 because you're at a max loss. The credit, no, it's going to jump around quite a bit. But if you wanted to keep your strikes up here, you could. I'm going to February 9th. And then that's when you look at me like, Logan, how is my credit so big if I'm widening it by 5? Well, you're so deep in the money. And this is what I call like a Hail Mary roll, is like, you're not getting out of this trade by then, but if you really had to, and you had like, you're adding $5. So let's say for some reason your net liquidity is low, or you don't want to see a buying power reduction, you could work this order and see, I don't know why I filled at 660. That's a little unrealistic. You're not going to get 660 on that, because if you look at the max loss versus what this width would be, well, maybe you could. I just don't think that's very realistic to get over 5 on it. But let's say you were to fill then. That's the only tough thing about on demand. You would fill for about 480, 475 because you're so deep in the money, right? Like if you're kicking these out, now you got a credit. You got a huge credit. Look at that. Your cash and sweeps up to 109. That's great if you filled at 660. Let's say you filled at 440 here though, or like 450. Because what happens is you don't see a buying power reduction, and your cash and sweep goes up. So now your account's up to 109,000 in cash and sweep, but your net liquid's still, 91 right now. Definitely not ideal, but you're just kicking the can down the road. You're like, I don't want to deal with this until the 9th. You could have pulled your strikes down, right? You could have looked at deltas. But that's for the next video. This one that's just a little secret. I'll get more into this strategy on this one in the next video, like the Hail Mary roll. Maybe I'll have something to show you guys because I have a couple deep in the money spreads at like 4,600 for mid-March that I'll probably roll live so you guys can see actual fills. So yeah, that 94K, disregard this fill at 660, take it down to like 460, 480. Now let's go to February 9th, right? Where the market was pretty good around the 9th, if I recall. Gosh, I can't believe it's already been a month, which is crazy, right? So this will be the last thing I show you guys in this video. The laptop's burning out in battery a little bit. And I just want to do a super quick and easy, just how to roll an option, especially deep in the money, right? So widening collateral. If you're very deep in the money, you have to have extra money. That's very important. Number two, that's why I only trade SPX. Like I said, you can't get assigned. Now, granted, if you ever get assigned on an option spread, you got to remember that's why you have the other leg. You have sold a put and bought a put if you're selling a put credit spread as insurance. So if you can't have an unlimited loss, right? So by selling the, like, let's say you're selling SPX 4,700, right? 4,710. You can't get assigned on SPX. That's why I trade SPX. But let's say you're selling like Google and you had a 2,900 and a 2,890, right? And it's 10 wide. By doing that 10 wide that you're trying to manage deep in the money, you can see the market was actually bouncing back quite a bit on February 9th, which is the date this expires, but you're still at max loss, but your credit's actually, the mark's looking a lot better because you're not as in the money. That's the other thing though, with Google, if you get assigned, or Amazon, or all the other big Apple, big tech, Tesla, whatever, right? That's just not ideal. But if you ever do, you know, that's why it's like, oh, you own all these shares at 3,000. It's like, no, you can just take the buy leg and then there's your max loss. It was like $1,000. But even like if you're like, oh, I didn't have time to roll it and I got assigned, you can literally just open that position back up again, because all rolling is opening and closing a trade at the same time, at the same order, you know, and it preserves your capital. So last thing I want to touch on before I run, let's say you want to roll this again. Now the market's catching up with your price and you're like, oh shoot, I really don't want to widen this anymore, but it might be the best thing to do. So you kick it back out and now you can bring your strikes down by widening, which is cool too. This probably isn't the best example because the market had actually rebounded, but let's say you wanted to go to like 46.60 and then you could really pull this down 46.40 and you're still paying a debit. But at this point, it's like, oh, I really want to get out. The stock price is from my long leg, because all you need is the spread. Basically, the stock price to get to your long leg to start reducing your strikes. If you either want to lessen it or get your deltas better, and then we'll jump into delta matching and how, like, by doing rolling this way, by pulling your strikes down, even if you're not out of the money on your expiration day, you can either then roll it out further, pull the strikes down, or you can start reducing the collateral in your spread, which is a really nice way to free up buying power if you're ever running low or you don't like as much max risk as you're at. And paying a debit on a roll isn't bad, right? You're just helping your probabilities out. You just don't want to get to the point where like your spreads are so wide that any sort of rolling that you do, because I talk to a lot of people who would maybe have like a spread like this on, that's 55 points wide. It's going to be very difficult for you to roll just because finding a good profitable spot when you're like 50 points wide on SPX is very difficult. Plus the options pricing gets really bizarre. So at that point, it's not the greatest spot to be in. Still, you're still able to get out, but at some point, personally, I try to avoid trading that way. Like I never start with a position bigger than, personally, 10 wide is the biggest I'll go on SPX, which is $1,000. And then you size your contracts according to your account size. And we can do a video like that if you guys ever want to, but try to avoid doing that, right? Getting super wide on it. But then you can roll these down, widen it again, pay the $70, right? Or whatever. See what this fills us at. Yeah, paid $70. And now your cash and sweeps down, but you got to remember, you're getting so many nice credits. This is all capital preservation. Your net liquidity is bouncing back. So as the market pops back, you can get out of your position. So that's why I always say leave a bunch of cash in. Personally, I don't even like to size in with over 20% of my account on initial position. And even if I do that, like I'm rolling it before it gets in the money. And sometimes you can't help it, but that's why I keep cash on the side, of course. And then I know I can continue to fight this. And then we'll get more creative as far as like pulling one contract down at a time. And the next one, delta matching. And this is why personally as a stock trader, like I only trade credit spreads or mainly like as my main focus. I do debit spreads occasionally and I'll buy calls occasionally and do some calendars here and there. But I personally just feel so comfortable selling credit spreads on SPX. You can't get assigned, you have tax advantages. And then if you ever do even let anything expire as a max loss, because you're like, I just don't want to deal with it, you could literally wake up the next day and risk 500 of your buying power to make that $6,000 back or whatever. And it's literally the equivalent of like paying 500 in a debit, right? To your buying power. Pretty similar. So that's going to be everything for me in this video. I hope you guys found some value. If you do, make sure you leave a like, and then don't forget to use that Lolly link. It's completely free to sign up. Bitcoin rewards for everybody. So I really appreciate it. It means the world to me. My birthday's in 2 weeks. So March 20th. I'd be the best present ever. So I really appreciate you guys' support. Leave questions below if you have them, and I'll go over delta matching, get more in depth, and we can make a whole rolling series so you guys can look at the market like I do and just not even be worried when your positions are upside down like $6,000, $8,000, $10,000, 20, 30, like whatever it is, right? Based on your size. I should talk in percents, but I know you guys like the money analogy too. But that's going to be everything for me. I hope you guys have a fantastic rest of your day. Happy Sunday. I'll see you guys soon.